Vandana Hari, a founder and CEO at Vandana Insights, joins in on the show to talk about what's going on with commodity markets. Vandana, good to have you on the show. What, according to you, is happening in crude? I mean, this overnight spike of 4% that one saw, what explains that, Vandana?
Hi, good morning. We might be at an inflection point for the crude markets, as you were just alluding to. One of the major news and rather surprising turnaround, I would say, of events is that it looks like the US and China may bring their trade negotiations back on track. Now, we know that those talks broke down, it seemed irretrievably at the start of May. And that was a major bearish factor on crude prices. So we saw crude tumble 20 to 22%, depending on whether you're looking at Brent or WTI, purely as a result of the worsening trade war between US and China. And then we've had a spate of macroeconomic data from not just US and China, but even other major economies across the world, which has been not too encouraging. And that resulted in a lot of analysts revising down their expectations for global oil demand growth. Now, I think this could be a major turning point if Xi and Trump do meet up. And to use Trump's words, he said he's going to have an extended meeting, quote unquote, with Xi. And the two teams from the negotiating teams from the US and China are going to meet ahead of the meeting of the two presidents, which all of which conveys to me a sense that they are trying to get the negotiations back on track. Now, I say it could be a game changer because this will prompt another revision, a turnaround in global oil demand expectations. So this could be a big positive for crude.
Okay. Fair enough. So things are sadly looking up, Vandana. But, when we did see the kind of weakness that we saw on those crude prices on the back of, worries to do with demand, what was your sense? How are you reading into that? Because the kind of volatility that we've seen or the sharp moves that we've seen on crude, I don't think we've seen, something like this, at least not for a while. Do you feel that what we're seeing here is more structural, or do you feel it's just at this point incredibly, sensitive to what we're seeing on the geopolitical front?
So a couple of factors I would like to mention in relation to the volatility that we've seen in crude. One is, and I think this is important to bear in mind, that there appears to have been a divergence between the euphoria, if you will, that we've seen in the stock markets ever since the Federal Reserve chairman and some of the senior officials started indicating a dovish pivot. And this happened around the end of May, early June. We saw quite a substantial rally, especially in the US stock markets and to some extent the global stock markets. But crude didn't really respond to that. What that tells me is that while a rate cut may be seen as obviously a positive, as a supporting factor for the stock markets, it would not necessarily offset the impact of the US-China trade war. So there was a bit of divergence, which is why we've seen a bit of uncertainty lingering in the crude markets. The other reason was, of course, heightened geopolitical tensions in the Middle East. Let's not forget, we had these attacks on two oil tankers in the Gulf of Oman last week, coming just within a month of attacks on very similar attacks in the same region on 4 oil tankers. So that injected a bit of a geopolitical fear premium in crude. So right now, I would say crude would probably still take support from, if we later tonight we do hear the Fed signaling a rate cut. I think crude will be supported, but it'll probably be a little bit cautious because, again, as I said earlier, does a rate cut, which is positive clearly for the stock markets, does it do that much for putting the global economic growth back on track? I think that's a big question mark. But then if US-China trade talks are back on track, I think that's probably going to be a much bigger impetus for crude prices to move higher.
Right. Vandana, I also wanted to ask ask you about refining margins. What is the outlook, and what, according to you, are the triggers that refining margins have been subdued for such a long time?
So we have seen refining margins have been nothing worth writing home about pretty much since late last year. There was a major drop in December, and that sort of modest, not too great margins have persisted since the start of this year. Q2, especially in Asia, Q2 has not been any much better than the first quarter of this year. See, the refining margins obviously will track two major things. One is what are crude prices doing, and what are refined product prices doing, which are very directly related to sentiment-wise as well as actual refined product demand-wise, directly related to what is the health of the global economy, essentially, right? Now, crude prices have, of course, they went up substantially and then went down quite a bit. Because of the worries over US-China trade war. If you look at products demand, however, it's not been very strong. And the other thing we've noticed is that there's also been a divergence globally. We saw that in May, for instance, global refining throughput was at a 2-year low, but that was more in Northwest Europe. And in the US Midwest, there were outages, there were maintenance shutdowns, but not so in Asia, as a result of which Asian margins did not pick up as much as some of the uplift that Europe and US saw, for instance, in the refining margins. As we go out into the third quarter and the fourth quarter, I think I see some factors on the horizon that might keep refining margins under pressure in the third quarter of this year. As refineries come out of maintenance and some of the other unforeseen outages end as well, a lot of refining capacity that was shut out of the market is expected to be back on the market. So obviously there'll be fiercer demand for crude that will support crude prices, and at the same time it might depress product prices because there will be much more product in the market. As we move towards the end of the year, looking at the fourth quarter of this year, there could be a substantial support, especially from gas oil or diesel, the middle distillate part of the refined product slate. As you know, we are going into a major change in sulfur specifications in bunker fuel starting the 1st of January 2020. And diesel demand as a result of that from the marine fuel sector is expected to go up substantially by up to 1.2 million barrels per day, purely as a result of this change, which means there will be more demand for diesel, and diesel cracks or margins are expected to be better.
Okay, Vandana, what are your expectations from the OPEC meet this time? Do you see Russia putting a spanner in the works, or what is the kind of outcome you're expecting from that meet?
As we began this year, and especially through the first quarter of this year, the market did sit up and take notice of difference in opinion that was starting to crystallize between Saudi Arabia and Russia. Now, of course, these are like the de facto leaders of OPEC and non-OPEC blocs, respectively. Saudi Arabia has continued to take a relatively hawkish stance, wanting to keep a very tight rein on the markets, wanting to maintain production cuts. They've been pointing out, the oil minister of Saudi Arabia has been pointing out that OECD stocks have continued to increase rather than decline since the start of this year. And Russia, on the other hand, a little bit in the same tune as they've been since 2017, have been taking a more moderate approach. However, I think as a result of the last few weeks' sharp decline in oil prices and the uncertainty over global oil demand growth, I think Russia has been coming around to the Saudi viewpoint that it is better to continue restraint on output in the second half of this year. I do expect that they will roll over the cuts, about 1.2 million barrels per day combined cuts that they have pledged. An interesting point to note, however, is that OPEC actual cuts are way beyond what they had pledged. OPEC had pledged only about 800,000 barrels per day as its share of cuts. It's actually been cutting, the 11 members have been cutting close to 1.1 million barrels per day. The Saudi Arabia has been at the forefront of that, cutting nearly 660,000 barrels per day, more than they need to cut. I believe that even if the 1.2 million barrel per day combined cuts figure will be just a figure on paper, I think the actual cuts by OPEC will probably be higher if Saudi Arabia remains dissatisfied with the level of inventories and with the crude price levels.
Right. Okay, Vandana, great to have you on the show. Thanks much for taking the time out and speaking with us today.